Hello and welcome to AI Market News by LM. Today we are diving into an incredibly intense and highly anticipated topic that's literally sending shockwaves across global trading desks. We're looking at the fierce currency intervention war surrounding the Japanese yen. The burning question on everyone's mind right now is this: is the yen destined to hit the 160 mark against the US dollar once again? Let's explore what we can expect from the markets today, analyzing the data, the macro sentiment, and the major economic indicators shaping our reality. Based on the prepared resources and various news commentary monitoring the situation, we recently witnessed a massive 1.8% surge that rapidly pushed the yen to 155.04 against the dollar. This dramatic movement during Asian trading hours strongly points to suspected intervention by the Bank of Japan and the Ministry of Finance to prop up the currency. A straight vertical move like this carries all the hallmarks of official intervention. Basically, they're attempting to squeeze short sellers and break the momentum of a depreciating currency. To truly understand the magnitude of this, we've got to compare it to other major currency pairs. While the US dollar-yen pair is experiencing wild, historic volatility with massive intraday swings, the euro-dollar pair tells a completely different story. As seen in the provided information, the euro-to-dollar exchange rate is trading quite steadily around the 1.169 level. This stark contrast really highlights just how localized and incredibly intense the pressure on the Japanese yen truly is right now. But here is where the mechanics of global finance gets super fascinating. If Japan wants to maintain its prestigious classification as a free-floating currency, well, there are rules. According to the input sources, the International Monetary Fund has specific guidelines, generally limiting interventions to 3 instances over a 6-month period. Because Japan recently acted, it's widely believed they might only have 2 intervention windows left before November to safely maintain that free-floating status. This means every single move they make from here on out has to be incredibly strategic. And it turns out, the options market is pricing in quite a bit of skepticism regarding the ultimate success of these interventions. The data reveals a 56% probability of the yen sinking right back down to that critical 160 level by the end of June. The fundamental gap in interest rates between the US and Japan remains wide, meaning the underlying downward pressure on the yen is still very much present, despite these multi-billion-dollar official actions. Section 1. US equities hit record highs. Okay, let's dive into this. Because while the currency markets are locked in battle, the equity markets are painting a picture of sheer optimism. We're looking at some truly remarkable levels across the major indices here. The S&P 500 closed at a record high of 7,259, while the tech-heavy NASDAQ broke past 25,326, gaining over 1%. The Dow Jones is also showing robust strength. This massive market performance is being heavily driven by an insatiable demand for technology and AI data center infrastructure. The capital expenditure pouring into processing power and tech development just continues to propel these benchmarks into entirely uncharted territory. So what's making this rally possible? It's really a tale of 2 very different commodities, silicon and oil. We can contrast the massive tech stock rally with the simultaneous drop in Brent crude oil, which has actually fallen back below the $110 per barrel mark. This easing in energy prices is largely tied to diplomatic hopes for winding down the Iran war. As geopolitical tensions show potential signs of cooling, the risk premium on oil decreases, and that in turn relieves some of the heavy inflationary pressure that equity investors had been fearing. Section 2, decoding the macro sentiment. Now, what's really interesting about this is how we measure the current reality. To gauge if this rally is built on solid ground or just pure emotion, we monitor the 7 pillars of the CNN Fear and Greed Index. We look at market momentum, breadth, and the strength of stock prices. We track put and call options activity, as well as the VIX for market volatility. Finally, we assess risk appetite by looking at the safe haven demand for stocks versus bond returns and the demand for junk bonds. Together, these 7 indicators tell us exactly what underlying emotion is driving global capital flows on any given day. But, equity sentiment doesn't exist in a vacuum. We really must guide our attention to the bond market, where Wall Street is heavily focused on the trajectory of rising yields. Despite the recent dip in oil we just talked about, overall strong economic data and lingering sticky inflation concerns are absolutely keeping pressure firmly on the bond market. In fact, the US 30-year Treasury yield recently hit a peak of 5.03%. That is a huge deal. The massive, capital-intensive AI investments we discussed earlier, combined with shifting expectations regarding the Federal Reserve's timeline for rate cuts, are totally fueling this upward pressure. A yield holding around the 5% mark signals that the broader market believes higher borrowing costs might be with us for quite a bit longer than previously hoped. Adding to the complexity for the Federal Reserve are the latest labor and service sector readings. We saw March U.S. job openings, known as JOLTS, fall slightly to 6.86 million, though hiring itself actually saw a modest rebound. Meanwhile, the ISM non-manufacturing index for April dipped to 53.6. While it's still in expansion territory, it definitely shows a slight cooling. These mixed signals create a very complex picture for FedWatch expectations, meaning there is absolutely no clear-cut path for monetary policy right now. Section 3, the week ahead. Now let's pivot to what we should watch next, looking at the upcoming economic schedule sourced directly from investing.com. Walking through the key U.S. macroeconomic events scheduled for today, May 6th, keeping all times strictly to Eastern Time. Early in the morning at 4 a.m. ET, we get the MBA 30-year mortgage rate, which ties directly back to those rising bond yields we just discussed. Then at 5:15 a.m. ET, the ADP non-farm employment change will give us our next big glue on the labor market. At 7:30 a.m. ET, we'll see the latest crude oil inventories, which is crucial for tracking that energy price dynamic. And finally, at 10 a.m. ET, Federal Reserve Bank of Chicago President Austin Goolsbee is scheduled to speak. We should definitely monitor these events closely, as any surprises here could trigger major market impact and dictate the momentum for the rest of the week. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. As we watch the yen flirt with that dangerous 160 line, the ultimate question remains: is the Bank of Japan truly in control, or are they simply delaying the inevitable? Thanks for watching. Don't forget to like and subscribe.